Hey guys, welcome back. Today we'll be talking about 5 stocks that are most traded by volume in the Indian market recently. These are the kind of stocks you've probably heard about, and I'll break down what makes them interesting, what they're doing well, and where they might face some issues. And if you're new here, I'm Pradeep and I work 9 to 5 as a senior product manager and have managed to grow my wealth through smart investments on the side. On this channel, I break down complex finance topics into simple and actionable steps. And if you want to do the same, subscribe and follow along. And in this video, we're going to talk about a banking powerhouse with a 12.67 lakh crore market cap, a retail revolution that's changing how India shops, an energy giant transforming into a digital empire, the auto manufacturer leading India's EV charge, and a government-backed tech player that could surprise everyone. In the next 15 minutes, you'll get data-driven analysis of their latest quarterly results, key growth metrics, real risks and challenges, and future prospects based on concrete numbers. And whether you're actively trading or investing for the long term, understanding these market leaders is crucial for any serious investor. So let's dive in and see what the numbers tell us. Let's start with HDFC Bank. It's one of the largest private banks in India and it's been around since 1994. And here's an interesting fact. HDFC Bank isn't just a big name in India, it's also the 10th largest bank in the world by market cap. And it's a bank that most Indians trust for everything from savings account to loans and even digital payments. Right now, the stock is priced at 1,657 rupees and the bank has a market cap of 12.67 lakh crores. And over the past year, their revenue jumped a whopping 66%, going from 1.71 lakh crore to 2.83 lakh crores. And if you look at their profits, they've been growing at a steady pace of 23.5% CAGR over the last 5 years, which is amazing for a bank of this size. So what's next for HDFC Bank? They're focusing on attracting more high value customers and exploring partnerships with fintech companies to stay ahead in the game. Plus, they're heavily investing in digital banking, which has also been a big hit so far. But like any business, there are challenges, and competition is heating up from apps like PhonePe and Paytm, and stricter government regulations can also slow things down. Still, with a strong track record and constant innovation, HDFC Bank looks well positioned for the future. And with its recent mega merger with the HDFC Limited, it not only is the biggest private bank in India, but also creating a financial powerhouse with unmatched reach across urban and rural India. Now, this merger positions HDFC Bank to dominate housing finance, personal loans, and SME lending, which is great news for its long term growth potential. Now, next up is DMart, the retail chain that's become a household name in India. It was started in 2000 by Radhakishan Damani, and today it's one of the most trusted brands for middle class families. And their approach is simple: sell at low prices, keep operations lean, and expand rapidly to smaller cities where the competition isn't as intense yet. Right now, DMart stock is trading at 3,686 rupees with a market cap of 2.39 lakh crores. And one impressive thing about DMart is that they're almost debt free, which is rare for a company in the retail sector. And over the last 7 years, they've grown their revenue at an annual compounded rate of 23.3%, starting from 11,898 crores in 2017 to 50,789 crores in 2024. But here's something to think about. Their PE ratio is 89x, which means you're paying 89 rupees for every 1 rupee of profit. Now, this makes it one of the most expensive stocks in the retail space. And with online giants like Amazon and Flipkart becoming more aggressive, DMart needs to keep evolving its e commerce game to avoid losing its edge. That said, their focus on smaller cities and efficient operations still makes them a strong player in the retail space. And did you know this? DMart's unique business model focuses on owning most of its store locations rather than leasing them. And this strategy helps them keep costs low in the long run, unlike competitors who face rising rental expenses. And it's one of the reasons why DMart's operating profit margins are consistently around 8% even in a competitive market. Now let's talk about Reliance, the undisputed king of Indian business. Started by the visionary Dhirubhai Ambani in 1973, Reliance began its journey in oil and petrochemicals but has grown into a diverse empire with significant stakes in telecom, retail, and even green energy. Right now, Reliance stock is priced at 1,242 rupees and its market cap stands at a jaw-dropping 16.8 lakh crores, making it one of the largest companies in India. Now, Reliance has always been about staying ahead of the curve, and while the traditional oil to chemicals business still contributes a significant chunk of revenue, the real buzz is around Geo and their green energy ventures. Now, Jio's 5G rollout is set to redefine digital connectivity in India, and their big bets on solar and hydrogen energy could transform them into a global leader in sustainable power. And in FY 2024, Reliance recorded a profit of 79,020 crores, a 6.6 growth from the previous year. And what's more interesting is their EPS has almost doubled in the last 7 years, growing from 26.69 in 2018 to 51.45 in 2024. But like any large company, Reliance has its challenges. The volatility in oil prices affects their core business, and their massive investments in new projects mean they'll need to execute flawlessly to see strong returns. And a fun fact, Reliance has one of the largest retail networks in India, and its digital arm Jio has already disrupted the telecom industry by making data accessible to millions of Indians. And it's safe to say they're not just a company, they're shaping the country's future. And moving on to the next one, which is Tata Motors. Now, this is a company we've all grown up hearing about. It started way back in 1945 and has become one of the biggest names in India's automobile industry with a market cap of 2.85 lakh crores. Known for everything from trucks and buses to passenger cars, Tata Motors has already made a big impact in the EV space. Right now, their stock is priced at 775 rupees, and over the years, Tata Motors has faced some tough times, including significant losses in 2019 and 2020. But they bounced back strongly, reporting a profit of 31,807 crores in 2024. Now, their operating profits have also nearly doubled in the last 3 years, going from 32,287 crores in 2021 to 59,538 crores in 2024. And globally, Jaguar Land Rover continues to be a major contributor, especially with its focus on luxury electric models. And back home in India, Tata Motors is leading the EV market with the popular models like the Nexon EV. And they've captured a significant share of the Indian EV market, which is growing rapidly as more people switch to sustainable options. But it's not all smooth sailing. Rising raw materials costs are putting pressure on their margins, and the global economic situation is still a bit shaky. And their success will depend on how well they navigate these challenges while keeping up with the growing demand for EVs. Now, Tata Motors is also working on expanding its EV portfolio with plans to launch 10 new EV models by 2025, which is very ambitious. And this push aligns with India's goal of becoming a global hub for electric vehicles, and Tata Motors is already miles ahead in this game. And finally, moving to the fifth stock, we have ITI Limited. This is a government-owned telecom equipment company that's been around since 1948, making it one of the oldest players in the industry. This stock is priced at 443 rupees and their market cap stands at 42,538 crores. And ITI has been working hard to modernize its operations and focus on projects like BharatNet, which aims to bring high-speed internet to rural India. With a strong order book and government backing, there's potential for growth, but let's take a closer look at their financials. Right now, the company's numbers aren't very encouraging. They've been posting losses for several years and most recently a negative 502 crore loss in FY 2024. And the return on capital is negative at 8.43%, and they face significant delays in receiving payments from clients with debtor days averaging a massive 705 days. So what's next for ITI? If they can deliver on big projects like BharatNet and improve their efficiency, they might turn things around. But for now, ITI remains a work in progress and a loss making company, unfortunately, and investors should approach with caution. So let's have a quick recap by looking at how these stocks stack up against each other. And if you look at the best revenue growth company, it's HDFC Bank at the top with 66% year on year growth. And if we have to talk about the strongest recovery in this list, Tata Motors tops the list with 31,807 crore profit in FY24. And if we have to look at the most diversified stock in this list, Reliance Industries tops the list with 79,020 crores profit in FY24. And if you look at the best turnaround potential, it should be ITI Limited with government support, but has a lot to prove, and you should proceed with caution. Now, each stock has its own story and opportunities, so it's all about finding what fits your investment style. And that's it for today's video, guys. And I hope this breakdown helped you understand these stocks better. But remember one thing, investing is all about research and knowing your risk appetite. And if you like this video, please give it a thumbs up and subscribe to the channel for more simple and straightforward stock analysis. And let me know in the comments which of these stocks would you put your money on. And thanks for watching and happy investing.